Here is the illusion. An ETF looks like a simple basket you can trade like a stock. One ticker, one price, one button. Clean and easy. But behind that button is a structure, a portfolio, a net asset value, a market price, a bid-ask spread, fees, liquidity, tax mechanics, and large institutions that create and redeem shares. ETFs can be useful tools, but they are not magic. In this episode of The Finance Illusion, we break the simple picture apart and rebuild it piece by piece.
An exchange-traded fund is a pooled investment product. Many investors own shares of the fund, and the fund holds a portfolio of assets, such as stocks, bonds, cash instruments, or another defined basket. Each ETF share represents partial ownership of that fund portfolio and the income it generates. The exchange-traded part means those shares can trade on an exchange during the trading day, similar to a stock. That does not mean the ETF is a stock. It means the wrapper trades like one, while the inside behaves like a fund. Understanding the wrapper and the inside is the whole game.
ETFs are not a tiny corner of finance anymore. In 2026, the SEC described a market with more than 3,600 ETFs and assets above $10 trillion. The same SEC release noted that active ETFs, while still smaller by assets, have grown rapidly and now rival passive funds in number. That matters because the label ETF no longer means one simple thing. The market includes broad passive funds, active strategies, bond portfolios, sector funds, thematic funds, and more complex products. So the first analytical question is not, is it an ETF? The first question is, what kind of ETF is it?
A traditional mutual fund is usually bought or redeemed at the end of the trading day at net asset value. An ETF trades throughout the day at market prices that can move above or below its net asset value. This is why ETFs feel more flexible. You can place market orders, limit orders, and see prices moving during market hours. But that flexibility also introduces trading details that mutual fund investors may not think about as much. Spreads, premiums, discounts, order types, and intraday liquidity. The convenience is real, but it has mechanics attached. Net asset value, or NAV, is the value of the ETF's assets minus liabilities divided by the number of shares outstanding. The market price is the price at which ETF shares trade on the exchange. Those two numbers are usually close, but they are not guaranteed to be identical. If the market price is above NAV, the ETF is trading at a premium. If it is below NAV, it is trading at a discount. This is one of the first hidden layers behind the single price on a brokerage screen. The reason ETF prices often stay near NAV is the arbitrage mechanism. If ETF shares trade too high compared with the underlying basket, authorized participants may be able to create new shares and sell them into the market. If ETF shares trade too low, redemption can work in the opposite direction. This process is not magic, and it is not a guarantee that every ETF will always trade perfectly at fair value. It is a market mechanism that can help pull price and value together when the underlying holdings and trading conditions support it. Retail investors usually buy and sell ETF shares in the secondary market. They do not normally exchange directly with the ETF itself. Large financial institutions called authorized participants can create or redeem large blocks of ETF shares, often called creation units. In a creation, the participant delivers a basket of securities or cash to the ETF and receives ETF shares. In a redemption, the process runs in reverse. This mechanism helps keep the ETF market price close to the value of the underlying portfolio, although stress and unusual markets can still create gaps.
Every traded security can have a bid and an ask. The bid is what buyers are willing to pay. The ask is what sellers are willing to accept. The difference is the spread. For a highly liquid ETF, the spread may be very small. For a thinly traded or specialized ETF, the spread may be wider. A spread is not a management fee, but it is still a trading cost. If someone buys at the ask and immediately sells at the bid, the spread can create an instant loss.
This is why order type and liquidity matter.
ETFs have operating costs. The expense ratio is the annual cost deducted from the fund's assets to pay for management, administration, and other expenses. A low expense ratio can help, but the lowest fee is not automatically the right answer for every purpose. The investor also needs to consider what the ETF owns, how well it tracks its objective, trading costs, spreads, taxes, and risk. Fees look small in 1 year, but repeated costs can compound over long periods. The lesson is not fee obsession, it is fee awareness.
For an index ETF, the promise is usually exposure to a benchmark, not a perfect copy of every return number. Tracking difference is the gap between the ETF's return and the benchmark's return over a period. Tracking error describes how much that gap varies. Fees, trading costs, sampling, cash drag, foreign market timing, taxes inside the portfolio, and securities lending can all affect the result. Two ETFs following a similar benchmark may not behave exactly the same. That is why a clean chart needs a second question. How closely did the fund actually deliver the exposure it claimed?
The word ETF covers many different products. A broad stock ETF may hold hundreds or thousands of companies. A bond ETF may hold government or corporate debt. A sector ETF may focus on one industry. An international ETF may add currency and country exposure. An active ETF may rely on a manager's decisions instead of passively tracking an index. Thematic ETFs may target narrow stories such as clean energy, robotics, or a specific trend. These are all ETFs, but their risk profiles can be completely different.
Many ETFs are passive, meaning they try to track an index or benchmark. The goal is not to beat the benchmark, but to follow it closely after costs. Active ETFs are different. They seek a stated objective using manager decisions, security selection, or a more flexible strategy. Active ETFs can be useful for some strategies, but they also depend more heavily on manager skill, process, fees, turnover, and risk controls. The label ETF tells you the wrapper. It does not tell you whether the strategy is simple, complex, passive, or active.
An ETF can show trading volume on the exchange, but liquidity has layers. The first layer is the ETF shares market, how easily the ETF shares trade. The second layer is the liquidity of the underlying holdings. A broad ETF holding liquid large company stocks may behave very differently from a specialized ETF holding thinly traded bonds or niche assets. In calm markets, the layers may feel invisible. In stressed markets, the difference can matter. Liquidity is not just whether the ticker moves, it is whether the underlying assets can support fair and orderly trading.
Because ETFs trade on exchanges, execution mechanics matter. A market order focuses on speed, not a guaranteed price. A limit order sets a price boundary, although execution is not guaranteed. Wider spreads, fast markets, thin trading, or unusual market hours can make execution more important. This is not a trading recommendation. It is a reminder that ETFs combine fund exposure with stock-like trading. The exposure decision and the trade execution decision are separate layers. A strong investment idea can still be entered poorly if the order mechanics are ignored.
Many people hear ETF and assume diversified. That is not always true. Some ETFs hold a broad market basket. Others concentrate in one sector, one theme, one country, one commodity, or even a very narrow strategy. A fund with many holdings can still be concentrated if the largest positions dominate the weight. Diversification is not a word on the label. It is a property of the holdings. To understand the risk, look inside the ETF. Number of holdings, sector weights, country exposure, top positions, and how the index or strategy is constructed.
ETFs are often described as tax efficient because many use in-kind creation and redemption. That mechanism can reduce the need for the fund to sell securities for cash, which may reduce capital gains distributions compared with some mutual fund structures. But tax results depend on the ETF, account type, country, trading behavior, and personal situation. Dividends, interest, capital gains, and currency effects may still matter. This is educational, not tax advice. The correct takeaway is that ETF structure can help with tax efficiency, but it does not erase tax complexity.
ETF risks include market risk, tracking error, concentration risk, premium or discount risk, liquidity risk, and strategy risk. Leveraged and inverse ETFs add another layer because many are designed to achieve their objective over a short period, often daily, and can behave very differently over longer holding periods. A complex ETF is not made safe because it sits inside an ETF wrapper. The product document matters. The holdings matter. The objective matters. If the mechanism is not understandable, the risk is probably not understandable either.
Before using any ETF as an educational example, the documents matter. A fund's prospectus and website can explain the investment objective, principal strategy, risks, fees, holdings, NAV, market price, premium and discount history, and median bid-ask spread. The marketing name may sound simple, but the documents show the actual rules. A phrase like broad market, income, quality, high dividend, innovation, or low volatility can mean different things depending on the methodology. The document step is boring on purpose. It is where the illusion loses oxygen.
A practical ETF research framework starts with the objective. What exposure is the fund trying to provide? Then look at the holdings. What does it actually own? Next, check the cost, expense ratio, trading spread, and possible brokerage costs. Then check tracking. Does it follow the objective closely? Look at premium and discount history, trading volume, and underlying liquidity. Finally, ask whether the exposure fits the investor's overall plan and risk tolerance. This is not a recommendation checklist. It is a way to understand the tool before using it.
The finance illusion is that an ETF is one simple thing. The reality is that an ETF is a structure. It can be broad or narrow, passive or active, cheap or expensive, liquid or fragile, simple or complex. The ticker is only the surface. Underneath are holdings, rules, fees, spreads, premiums, discounts, taxes, and risks. ETFs can be powerful educational examples because they show how finance often works. The visible button is simple, but the system behind it is where the truth lives. Understand the structure, and the illusion loses its power.